Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and we're really starting to see the chips settle in terms of what is going on around the economy, what's going on with stocks, what's going on with gold and silver. And as a fallout of the pandemic, I don't even know if the pandemic's even news anymore. It seems to be all about the rioting now and race wars. But I have on the line today Gregor Gregersen of silverbullion.com.sg. And we're going to be discussing the economy today, especially as it pertains to our money, savings, and wealth. So, Gregor, thanks so much for coming on Crush the Street with me once again.
Yep, I'm happy to be here.
Gregor, let's talk a little bit first about your initial reactions to what's going on with the virus and how the economy is reacting to these global shutdowns and these ongoing shutdowns.
Well, I think you can argue many ways of what is going on, is required or not required. But I think, as a bullion dealer, and the reason we started silver bullion is because we expected a big crisis to happen. It was really 2008, and the financial crisis in 2008, which got us into this business and got us interested in precious metals. So I'm surprised that it took until 2020 to get into the next big crisis. And of course, I'm surprised that it ended up being a coronavirus, which sparked all of this. But what we've experienced from our side in the bullion business is an incredible uptick of demand. I mean, in March, our sales have been about 6 times the best we've had before, the best months we had before. So, essentially, this crisis is creating a lot of fear in people, and I think in a justifiable way, because you start with the mainstream economy essentially going down. After you have that, this might morph into a financial crisis, as financial institutions might end up picking up the defaults of the customers and might end up into troubles themselves. And if things go really bad, this might morph into a currency crisis. And if you are in a currency crisis, that's when you really need to have gold and silver, because by definition, say the US dollar itself might be in doubt. And remember that the US dollar is just based on the full faith and credit of the United States. So everything is based on trust. And if this pandemic is the beginning of an erosion of trust, then this can be very big consequences indeed.
Gregor, we saw a leveling off of toilet paper in the grocery stores, this panic of empty shelves, and to a certain degree, the supply chain start to catch up a little bit. What's the situation in precious metals now that we're 2 months into this? What are we seeing on the supply, the demand front, and where are the chips starting to settle? And I'll add the caveat that we're starting to see a new sell-off in the overall market. So, is it dependent on a crisis on the equity markets to kind of flush out what's going to happen in precious metals, or are we seeing an ongoing demand for precious metals despite what's going on in stocks?
Well, I will preface by saying that the price of gold and silver and the demand of physical bullion is not directly related. That might sound funny, but the price of bullion is mostly determined in the future markets by people who basically are betting paper gold without needing to get any physical. So what we saw, especially in the case of silver, you need to keep in mind that the silver market is 200 to 300 times smaller than the gold market. So when the crisis started, silver prices fell from $18 to about $12 in a very short period of time. So there was a real bloodbath. But at the same time, the physical demand ended up spiking. It went way through the roof, which means very soon supply was very difficult to get for silver. And you saw premiums going up. So what typically happens in these situations is that coins will be the first to be sold out. So American Eagle coins, Royal Canadian Mints, they ended up becoming very difficult to get in March, and they're still almost impossible to get from the mint. So the only supply is really people selling it back. And as dealers, we've essentially been raising the buyback rates. I mean, we're buying back Maple Leafs Eagles at maybe 30% of our spot silver price in order to encourage people to sell back. But essentially, it is difficult to get small bars of silver. It is difficult to get coins. It is difficult to get gold coins, maybe a bit easier than silver. But what we can still get relatively well now are the large 1,000 ounce LBMA bars. And we're starting to see a little bit of liquidity or supply coming back on the 15 kilo size. For gold bars, 1 kilo bars we can mostly procure. 100 gram bars a little bit more difficult. Everything below that is difficult to get. So the problems are not just supply, but also transport. If you're looking at silver, we normally buy, say, 3 or 4 tons of silver at a time. And putting 4 tons of silver in a plane has gotten a lot more difficult. So, you know, for us, when you're sourcing these things, you have to think of how you're getting it over here. And if you cannot get it over and you don't have a timeline when to get it over, then it's a very risky thing to buy. So these are some of the issues that you're facing as a bullion dealer to get supply. But as a quick summary, in March was really bad. In April, things have slowly improved, and right now we're seeing a gradual improvement.
So improvement, what does that mean longer term? You know, what does that imply? Improvement where we're getting back to normal, how things were in 2019, premiums coming down, and you know things going back to normal, or are you expecting, you know, an ongoing breakout for the precious metals in this environment?
Well, if you look at, you know, say 2008 for guidance, for example, when 2008 came along, silver fell from $14 to $9. This time around, it fell from 18 down to 12. But a year after it went down to $9 in 2008, 2009, it started rebounding and went up to $49. So I think that both gold and silver are going to be going way up after this crisis, because the reason is a lack of trust. I think this whole crisis is just starting to play out, and as things go along, people are now aware that it is not always business as usual. It is not always that normalcy bias which, you know, reigns everything. So starting to realize that some things might not be the same tomorrow. And once you start thinking that way, it starts making a lot of sense to take a little bit of your wealth and buy physical gold and silver. And because of that, we're going to see an increase in physical demand. And we're also going to eventually see these paper prices, which have crashed because everybody was liquidating everything because of margin calls, also starting to come back up and go up. So I'm very bullish on gold and silver. The reason why silver is expected to go up a lot more is because silver is extremely cheap compared to gold. The gold-silver ratio is around 110 right now, which is, you know, close to a record low. And so I would expect silver to outperform gold in terms of appreciation.
Gregor, we saw a negative oil price on the futures market for the month of May. And I'd like to get your thoughts on that. Maybe the differences between what happens in oil as it pertains to metals. And, you know, I think it was a real important moment for headline news that markets can break down. And so, having said that, I mean, what are your thoughts with, you know, kind of what you saw with oil and maybe the differences, similarities, or possibilities that could happen in precious metals?
Well, to some degree, I was saying, oh, I'm glad I'm not in oil, because once you think of it, I mean, oil is a liability if you don't have a place to put it. So the market ended up going, I believe, down to negative $37 per barrel at one point, because that oil had to be delivered. That's how future markets work. And there wasn't any place to put it. And if you end up spilling the oil in the ocean, you have a heck of a problem. So suddenly, you know, that's not something that can happen to gold or silver. because it's not something that you consume, and it's a lot easier to store gold and silver than oil. To me, I think what was more relevant was that temporary closure of the London bullion market exchange. And what that caused is the gold price to start to diverge, because the gold price is traded through different exchanges as well as on the future contracts, which are traded 24/7 or 24/5 across the world. And with the London market closing, suddenly the two prices diverged. And what happened on that day, it's really interesting to see. Our price and Kitco's price ended up being $80 higher than a number of other prices. And suddenly we didn't know, what is the spot price? Is the spot price $1,620 or $1,690? And it took a few hours, for them to start coming back down. And what we also saw is refineries, which would normally sell gold, maybe at $3 above spot, they suddenly were charging $12, not because they couldn't get the gold, but because the bankers, such as JP Morgan and so on, which were doing the hedging for the refineries, were charging $9 in hedging fees. So you had all of these sort of repercussions that started coming because the shutdown of the London bullion market exchange. And the question was going to start, if this is going to get worse, can there be a default on COMEX? I mean, these questions are always coming up. And
let me jump in. So it's interesting, with the oil market, you had a situation where the delivery couldn't be stored, but in precious metals, if you had a situation like this, it's the product can't be delivered, right? To completely.
I mean, in precious metals, you never have a problem that you cannot store it.
Right.
I mean, somebody want to give you 10 kilos of gold, you can always put it somewhere. You don't need special facility. I mean, you need to keep it safe, but for short-term storage, I mean, you put it in a room and you close it and you guard it and you're okay. But you can't do the same thing with 5,000 tons of oil. So you're not going to have that problem. You're never going to see negative gold or silver rates. That doesn't make any sense. And keep in mind, it's the oil rates. That was only for the delivery, which was going to be due the next day. Because these deliveries are, I believe, once a month or so. So the next contract was actually trading at $18, $20 or something like this. So it was a really special case, but that wouldn't happen in precious metals. In precious metals, the worry is maybe it's the opposite. There's so much paper gold out there. If people start asking for physical delivery, will I be able to get it? What if it's not possible to get it? And Warren Buffett, he showed us what would happen in the case of silver back in the early 90s.
As far as not being able to deliver, what do you suspect would happen to the futures price? Would the paper price collapse and physical markets, like at bullion dealers, go up? I mean, what could potentially? I know it's probably an unknown exactly how it would play out, but what would you suspect to play out?
Well, I don't have to suspect, because it pretty much happened 2 months ago, that we would have a price divergence. So when the silver price, I'm using silver because it was more extreme, the movements, and the shortages were more acute. So it's a better way to illustrate it. But it kind of applies to the gold as well. When silver fell to $12 and we started having this incredible demand for physical, we ended up with a product whose price keeps on falling and demand keeps on going up. So the natural result of that is a shortage. So what happens in the precious metal market is that the premiums will go up. In other words, silver fell from $18 down to $12. And normally, if you buy a coin, you might end up paying $2 premium for it. So if it's $12, you might have to pay $2 for it, $14 to buy it. Well, APMEX and throughout the industry, the dealers ended up charging $12. So if you actually wanted to buy that silver coin, you weren't getting it for $12. You weren't getting it for $14. You had to pay $24 for it.
Mm.
So in essence, that's price divergence. There's the spot price, which was $12, and then you have the premium, which essentially pushed it up. Now, the spot price is only relevant if I can get physical metal for it. If I pick up the phone and there's no way to get physical metal, I stop following it and I start making my own price. And whether that own price is the spot price plus a premium, with the premium changing, or whether you just make your own price, is kind of the same thing. So
Right.
essentially, the premium is what will increase in a crisis to reflect the demand for physical bullion versus paper bullion.
Gregor, maybe you remember this back when we saw that big bull market in the last, recession, going into, $49 silver, $1,900 gold. What was the premium dynamic when we got to those high numbers? Because obviously right now we're seeing high premiums, bullion dealers offering higher than spot to purchase back Eagles and Maple Leafs and things like that. What was the buyback prices when we saw that huge spike to $49 silver and $1,900 gold?
It was normal for us. So for silver, what you have to understand is these premiums normally are not percentage based. They're fixed cost. So if we are talking about coins, which have the highest premiums, if you're talking about a maple leaf is going to charge $1.50 for it to be produced at the mint. We will then have to get it shipped, say, to Singapore, wherever it needs to go, and say we'll get it here for 175 or 170, and we'll then make a profit on it and say our profit is 20 cents per coin, which means we're selling at 190 or 195, something like that. So our profit is 25 cents. If the silver price is $10 and there's a $2 premium, that's a 20% premium under normal conditions. Now, if the silver price goes up to $50, then the $2, that's a very small amount of the premium. We're talking about 4% or something like that. So on a percentage basis, as the silver price goes up, the premium actually keeps on going down. And when you have the crisis, these premiums go way up. Once supply comes back, and once we're seeing the paper prices going up, typically what happened back then was the physical prices stayed, at the $2, the physical premium stayed at the $2 level, the normal prices, which means that the actual premium in percentage terms was actually falling. So it's an interesting dynamic. It's just that when you have a crisis, basically people want to rush out and get gold and silver. And the reason why prices fall is because all these financial people are getting margin calls and they have to sell anything they can, which is why the paper prices are falling. And that's when the premiums have to come in to basically make up the difference between the physical demand and the decreasing prices of silver and gold.
Well, and it's interesting too, because I know a lot of people are, questioning the premiums, and it's a bit of a concern, because if people are buying at, $18 when the spot price was 18 and they were paying 20, and they're seeing $15 silver, and, now it's trading for 25. I mean, people are kind of wondering where they can scrape their margins on silver, but that's not why we got in this game in the first place. We're not looking for silver. At least personally, I believe silver is going much higher. I don't think we're going to be concerned about, $1 or $2 premiums, $5 premiums, when silver and gold ultimately do what they're going to do and reflect what's going on in the system. So I don't know, maybe I'll let you respond to that. And I actually want to get into some technology that you guys are working on.
Yeah. Well, basically, the premiums reflect the supply and demand, which is independent of the price. And that's the difficult thing to understand here. So that the price of silver and gold is not, in the short term at least, reflective of the physical supply and demand. It's just determined by traders in the financial market, and they might push it down, but the world might be really having a big demand for this silver. And the only way to adjust for that is to have high premiums. Essentially, as a bullion dealer, if I only have 10,000 maple leaves left, and I know I cannot get more of them, I have to find a new balance price where essentially the high bidders, which want to buy those 10,000 maple leaves, are going to get it. So basically, that's what the market was doing. That's what bullion dealers ended up doing. And of course, bullion dealers kind of look at each other and say, oh, these guys are selling at this price. Why don't we sell it at this price as well? And I guess it kind of finds a new price equilibrium at that point. And then as soon as supplies come back, these premiums come back to a more normal level. What I would like to add, though, is premiums are going up, which means people have to pay more for the silver. But if you sell it, you're also getting more for it. So that's the other part of it. So it's not all negative for the customer. The spreads for a dealer normally they will go up more than normal, and that partially reflects uncertainty. So we don't know where the price is going to be tomorrow and whether we can get prices back. But as a bullion dealer, once supply becomes hard to get, you want to raise up your buyback prices, because at some point you no longer care so much about selling silver or gold. You care a lot more about buying it back. That's, for example, what happened to us. I mean, to us, it became a lot more important. Hey, who can be convinced to actually sell us back gold or silver, and how much can be bid for sale gold or silver, than us actually selling it.
And why is that important? Just to clarify, for bullion dealers to be buying it back, or to be, just to have it on supply.
Because the Royal Mint and the US Mint basically didn't accept any orders anymore. So normally when you have a sale, you can put in an order to replace these coins. What happened in March is that we couldn't replace it. So once you sell it, you're out, you're done. So it's not about selling it, it's about making sure that you can still get some coins somewhere. And so bullion dealers basically change from being distributors of, say, a mint product to becoming an exchange, which is trying to get existing users to sell back the gold, silver to the bullion dealers so that they can sell it to somebody else. And the premiums basically becomes a price discovery mechanism to find the new balance. And keep in mind that premium is localized, because it might be a lot harder to get silver into Singapore, for example, than it might be to get in another country, or it might be easier to get in Singapore than somewhere else. So what you'll start seeing is that some countries might have higher prices or lower prices for certain items, depending on supply condition.
Gregor, let's talk about Gram Chain and this blockchain technology, which is basically a gold-backed token. Why is this important in 2020? Having something that's gold-backed and being able to trade a token in this world.
Yeah. So just a piece of background. I've been in technology for about a software engineer, senior data architect for major banks for about 20 years. And in silver bullion, most of my time was actually spent building most of our software that we're using. So I'm essentially this sort of geek. And about 4 years ago, we really started creating liquidity in Bitcoin through another company that we have. And this company was also the first company, or one of the first, to be able to get Lloyd's insurance for Bitcoin being stored there. But throughout this time, as you get to understand the industry more, you realize that the single biggest problem in crypto is how difficult it is to convert, say, Bitcoin into US dollars, and US dollars into Bitcoin. So it's a liquidity problem. And the reason why it's so difficult is because banks normally don't want to be involved with anything crypto. And the reasons they don't want to be involved are twofold. A, the official reason is AML KYC. They're saying that money might be dirty money, might be money laundering, it might be terrorism, blah, blah, blah. But that argument doesn't necessarily hold water as much as it does, because the regulators, actually the FATF, told banks not to de-risk, blanket de-risk, meaning you should work with bullion, with crypto entities, fintech companies, which have proper AML KYC procedures, because if you don't and you categorically stop transactions, that is going to push it into, say, underground, so to speak. Make a long story short, the reason why banks are using this as an excuse, but why they really don't want to be helping in any way to make Bitcoin cryptocurrency something that becomes more popular, is because it is a threat to the banking system. Banks are ultimately highly centralized entities, and they're becoming more and more so because in order to make a wire transfer, you have to have correspondent banks. And banks have been cutting correspondent banking accounts, and thereby they've been cutting out the smaller banks, and the big banks are becoming bigger and bigger, and more to the point where they cannot fail. So it's very much about centralizing everything. Then you take something like blockchain and Bitcoin, and you're looking at a fully decentralized system. So of course, banks don't want this to prosper or go anywhere. And by blocking the conversion of, say, Bitcoin into US dollars, that's the best way to block the adoption of it. And that's the problem, the biggest problem I think that we have in this industry. And so we believe that we have a solution, or at least a partial solution to this.
Gregor, it's interesting, talking about gold-backed currency, gold-backed money, gold-backed token. One thing that I'm always reminded about is the US dollar used to be gold-backed. There was this precious metals backing for the money. But what's the point if at any point the government can remove the backing and disconnect it? Is it truly gold-backed? It's not inherently gold-backed. It's not tied, right? It's not like a God's commandment that it's connected, right? It's just currently gold-backed, and then one day it's not. So talk about this gold-backed token. Does it have different properties than, let's say, a US dollar, which can be one day gold-backed and one day not?
Well, all of these currencies are just based on trust. Now, if you have, say, a gold-backed token, that's also partially based on trust. I mean, trust that the gold is there. Just because I'm saying there's gold, there's about 100 gold tokens out there, and none of them have really gone very far. And one of the reasons because of the lack of trust. So just to get back to a moment from the problem I was mentioning about lack of liquidity, what we essentially are saying is, instead of taking US dollars to Bitcoin, use US dollars, buy gold, tokenize that gold, then exchange the tokens for Bitcoins in a crypto exchange. Now, as you're mentioning now, why should somebody trust it? Because how do you know there's gold behind it? And how easy is it to convert your gold tokens back into physical gold bar? And that's essentially what we spend a lot of time to ensure that there is. And technically, the system that ensures that there is gold behind it in a token is called a proof of reserve system. And for us, proof of reserve is a gram chain system. And gram chain system is a system which we developed where we go to a third-party vault. We essentially give them RFID chips, tamper-evident bags, and a special application with RFID scanner. And they will then scan whatever gold is going in through a scan event. That data is recorded real-time going to an API. The data is hashed and is written to the Ethereum blockchain in order to create a tamper-evident hash of that event. That data is then stored in the gram chain website and database, and it's publicly available. So what makes the system unique is three things. A, we are not relying on any third-party documents. We are going right to the source, the guy who's actually handling that bar, to put in the information. Our system tracks who's doing what, where, when. That information has a hash on a public blockchain, so we can prove it has not been tampered with. And also the information is completely public in real time. That's the scan event. That's how we know what is there. We then record through the sign event who it belongs to. No, assuming that's wanted. But in a company like in the case of cash, that is wanted because cash wants to show which bars belong to cash. Now, you don't have to take cash's word for it. Instead, we are going to the vault again, and the vault is actually uploading the vault statement stating that this gold belongs to cash because cash will have an account with that vault. So you get to see the actual vault document for those specific bars stating the name of the company owning it. So you have a very good proof that indeed these bars belong to cash. And then we have another event, which is a lock event, which means that cash is actually locking these bars. Only once they're locked, we have a smart contract, this is called the token governor, which looks at how many grams of gold have been locked. And only then can we actually issue the tokens. There's a lot more information on it on the website on how it actually works, but essentially, it's quite a foolproof system. It has a lot of checks and balances. And to the degree possible, it is as distributed as possible. Right now we have Prinks, which you probably heard, is one of the largest vaulting companies worldwide, which has signed up with it. We have a contract with Cash to deploy the system. We have already deployed it with Loomis, which is also one of the largest vault operators, especially in Switzerland. And we pretty much made a partnership with Still Engage, who is running 4 vaults. We have it installed and running right now in IDS Dallas in Texas. And of course, the Safe House is also able to implement it. And we're looking at adding more vaults. So the whole system is essentially designed to be expandable. And it's not just limited to our application. GramChain can host different applications. A gold token is just one possibility. We are looking at expanding the peer-to-peer system, lending system we have on it. And third parties can also come in and use it. Auditors, we were talking with Ernst & Young, which are our auditors, to also use the system to actually prove through the scanners that the bar is there, instead of doing it the old paper type of way. So third-party companies such as valuators or auditors or testers can basically also use the system to create an event as a proof that they have been there and that the bar is genuine or whatever you want to do. So it's an expandable type of event recording system. It's a lot more than just an inventory system. And we are hoping that the system will have enough momentum in order to support more and more application. Right now, Cash is the ones that we are focusing on, which is a gold-backed token.
Gregor, it was an absolute pleasure once again to have you on the show and to educate us and to really give us a pulse on what is going on in the market here. Again, 2 months deep into this pandemic crisis, this economic shutdown, I really wanted to get an idea of what's going on in the precious metals market as the chips are starting to settle. And I think it kind of gives us an idea of where things are going to be headed going into the summer, depending on what happens, as the breakdowns continue, if we see more waves or if we see more political lockdowns. I think this is real possibilities here with the way the divide is around the world. We're seeing a real divide. And so I want to appreciate you for coming on the show. If people want to learn more about you, your work, or your bullion company, please let them know where they can go and what they can expect to find.
Well, if you're interested about systemic wealth protection, the different things we do and how to safely store gold or silver, again, you can go to silverbullion.com.sg. If you're interested in some of the crypto token that we talked about, or the GramChain system, cash.gold, that is cash like the cache memory. It has a triple meaning. It sounds like cash, but it's like a cache memory, C-A-C-H-E basically, .gold. And you'll find a lot of information about that there.
Thank you, sir. Appreciate you.